Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Welcome into, and thanks so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Dave Ross. 419-794-3030 is the phone number if you have questions about things we talk about today or just questions about your retirement in general. Want to know a little bit more? It's the number 419-794-3030. Online, arhq.com. My name is Chris Swan. Today on the show, just what is portfolio diversification and how can it help retirement savers? We'll talk about how to find the right financial advisor, and are Americans playing it too safe when it comes to growing their nest egg? All this and more, but before we get started, let me check in with the guys. Nolan, Dave, glad to be with you as always. How you doing today?
Doing really good. You know, I just got my daughter moved back, or my niece, I should say. Feels like my daughter, but my niece moved back to Ohio State this last week, so between that and then my youngest son starts his senior year over at Anthony Wayne next week. So it's back to school time around the house.
My youngest daughter is also starting her senior year, and she's playing tennis. And they had a successful start to their season on Saturday. So busy time in business and in life.
Definitely making sure that you make the most of those moments. You know, education never really stops. That's what we're here for on the show. So we appreciate you guys taking time out of your schedules to spend with the listeners and the viewers, help educate them as they get ready to embark on this next great chapter of life known as retirement. Let's start by turning our eyes to the market. Just a couple weeks ago, there was plenty of talk of interest rate cuts and perhaps even a soft landing for the economy. But after some deeply down days on Wall Street, the R word, recession, has again reared its ugly head. And economist Nancy Lazar tells Fox Business, quite frankly, we need one.
We would say we are now just moving into the high risk period of a recession. It on average takes 10 quarters after a Fed tightening cycle to dip the economy into a recession. And so indeed, we think it could be a painful as we move into the fourth quarter is when our best guess of when a recession starts. We think we need a recession in inflation, or we risk potentially going back into something like the early 1970s.
So here's the thing. A lot of us have money tied to the market, especially as we're getting approaching that retirement red zone. But is the market a reliable partner when it actually comes to retirement?
You know, we've been talking about this recession topic, I think, for a couple of years going on now. So, you know, whether we have it or not, it really is not going to have a really big impact on somebody's decisions for the long term on what to do. It's the markets will kind of get through it. And, you know, when I think about the markets, thinking about it being a reliable partner in retirement time, it just comes down to, you know, again, good communication like you should have with a partner and understanding, you know, how you work best together. And by that, I mean, I know, Dave, we had recently met with a new client and we had got together in her particular situation. And when we were reviewing her situation, what we had noticed is that over the years, she'd saved and accumulated a nice bucket of money that's in traditional bank accounts. That's kind of, quote, her safe money, where she had built that up and looked and rolled over an old pension into that account years ago. And then she had her 401k, which was the risky part about it. And in concept, when we looked at that, I generally like that type of an approach because, you know, she doesn't have all of her money in the stock market. She's looking to retire anytime soon. And the problem with the stock market is short term, it can be somewhat unreliable, meaning that, you know, we don't know what the lottery of the returns of the stock market's going to be. So for people that are at retirement time, the challenge of it being a reliable source is they say it's the lottery of the returns of the stock market. So what we did for her is we developed the retirement team action plan. That's the same team action plan that so many of our listeners and people that come into the office get to take advantage of. And when we go through that team action plan, we're looking at taxes, estate planning, asset protection, and money management. And what we worked on developing for her is what I would refer to as portfolio optimization. So part of that getting to be reliable in retirement time was looking at the safe money. And when we look at the safe money, she had a lot of the money in a traditional bank savings account. And surprisingly, that money was left there, earning very little to almost no interest. And what we've been talking about here on the radio for the past, year or so is where high interest rates are today. So we're able to give her some advice on how to optimize that money, get that working a little bit harder. Then when you look at the stock market part of the portfolio, we were able to take more of what I would refer to as a sniper shot approach in identifying very specifically what we want to own within the stock market part of the portfolio. As an example, I like cash-rich, low-debt, high-profit companies that have a competitive advantage and or are needed on a daily basis. So even in that part of the portfolio, able to make it probably a better partner for her as well. And Dave, when we were talking about this the other day, I know one of the things that you'd mentioned to me is that we don't oftentimes have people that come in that have equally built up that safe bucket of money and then risky money as well. So, kudos to her making some good steps. It was just us helping with the retirement team action plan to take it up a notch. But oftentimes you see a lot of people that come in at retirement time and still have way too much risk or equities in their portfolio. Isn't that sometimes what you see?
Absolutely. And I would go so far as to say that the most extreme situation that I ever saw was that a person had 4 different 401ks, and they left all of them when they changed jobs. They left their money in the plan at the previous employer. And looking at those accounts, you could tell how old this person was by the risk level of the 401k that they were in. So the plan that was in the 20s was very high risk. It was S&P, even greater than S&P risk. And each move, the conglomeration of investments got a little less risky. And quite honestly, there were a lot of moving parts, and we had to move all that money together and come up with the current risk quotient for this person and have them invested in a way that's consistent across all of their money and factoring in a safe bucket. So in this case that you and I worked on, I think we were able to really help her by taking a look at the safe money and seeing how we could increase her yield across the board within that portfolio while maintaining a risk that is appropriate for her during retirement time. And I think she made a number of very good decisions based on the retirement team action plan that we put together for her.
And if you're wondering the same thing about your portfolio, you're wondering, how much of the market should you have? What do you partner with? And what do you want to own? If you have more than $250,000 of retirement savings, we can provide you that same complimentary retirement team action plan. So what we'll do is we'll get together, we'll sit down, we'll spend just under an hour together going through looking at your individual situation and providing you advice on taxes, estate planning, asset protection, money management, and really how to bring it all together and hopefully get in a situation where maybe we could partner in retirement time as well. Happy to help out. Again, if you just call in, love to have you sit down and have a conversation with us.
That number is 419-794-3030. If you have questions about the market and recent volatility has made you nervous, bad decisions could undo what realize that you maybe have a little more risk in there than you thought. That retirement team action plan. If she came into your office and was sitting down speaking with you, Nolan, Dave, what would you tell her? 419-794.
Well, I think the downside of going through retirement without an advisor can be somewhat challenging. I know we oftentimes will get together with people who, typically do it themselves. And the nice thing about working with a retirement advisor is not all advisors work the same. So I'd really be curious about her comments regarding fees and bad decisions and ask her, why, is that causing you kind of headache? She probably had some type of bad experience in the past, I would assume. And, when I think about finding the right advisor, it's almost like, dating. You got to keep looking to find, what's best for your own individual situation. just like there's, good and bad advisors, there's good and bad stocks, there's good and bad investments that are out there. The advantage, I think, of somebody having an advisor in retirement time is they can take a look from the outside in. I know when we go through the retirement team action plan, we look at a lot of different areas of people's finances and start to bring up things that they didn't think about. A perfect example of that is even if you've paid off your mortgage, your banks, your credit cards, all of your loans, and you think you don't owe anybody anything, your retirement account is actually probably your biggest debt in retirement time. And the reason being is that the federal government says that they have an IOU against that account. And when you take money out of a traditional retirement account, they're going to tax you at whatever the income rates are. Well, as we know, the future tax rates could be significantly higher than they are today. So one of the things in the retirement team action plan that we take a look at is trying to reduce and eliminate strategies on getting tax rates to go as low as possible. And that could be things like a strategic and or tactical Roth conversion as just one of the examples on our tax savers checklist, which we go through 25 different things. As far as bad decisions and what she was also concerned about, I think the question there is making sure that you fully understand the ins and outs of any investment choice that you make. So again, some type of probably bad experience had led her into that situation. In terms of today, you have a difference between, what is a salesman and what is a fiduciary. And a fiduciary is someone who's, required to act in your best interest. I would say that I think even some, commission-based salespeople probably do a great job and, at the end of the day are probably wanting to do what's in the best interest of their client. But, making sure that you're asking the candidates about their background, how are they coming to develop what their recommendations are? What are the steps that they're going through, understanding how they're going to get compensated in the situation. I oftentimes find even in a lot of the relationships that we have, whether it's a do-it-yourselfer or somebody who just wants a second opinion, sometimes just hiring us in a consulting capacity can be just another guy that you can bounce ideas off of and say, hey, I'm thinking about XYZ. What do you think about that? Here's what my 401k investment options are. If you were giving us advice on maybe how to allocate that, how would that be? Obviously, as a retirement advisor, I'm certainly biased in the fact that I think it's a great idea for those of you who've built and saved up your life savings to have a coach, to have an advisor that help get you through the tough times and helps you optimize your overall portfolio. Using, in my example, 30 years of experience of developing plans, helping hundreds of families transition through retirement time. And when you look at it, I'd say the same thing. What are you talking to people about as far as sitting down, the value of working with you, Dave?
Well, I would think, the one thing that really was an eye-opener for me coming to work at America's Retirement Headquarters was that we don't have to necessarily have direct control over a client's retirement funds to be able to provide solid advice. And that's where I think this consulting relationship becomes very valuable, because sometimes you will come across a person who will say, gee, my brother-in-law is my financial advisor. I can't fire my brother-in-law, but he doesn't necessarily do planning. So we can help in the development of a plan. We can certainly help anyone who wants to have a good handle on what their risk level is on their portfolio. We can stress test their portfolio and talk to them about the pitfalls that they might be facing. So from a standpoint of commission-based versus fiduciary, the fiduciary standard is very real. We have to work in the client's best interest. And Nolan's correct. There are a lot of very good commission-based advisors, but maybe bringing us in on a consulting basis, knowing that their risk is appropriate, that their investments are appropriate, and that it fits into a tailor-made plan that meets their needs. I think that works out very well in a multitude of different situations.
whether it is having, a full-blown comprehensive retirement plan put together, or, just having an advisor, a fiduciary in your corner acting in that consulting position. I think it can hopefully add a little bit more confidence as you enter into retirement. It's kind of like the equivalent of, knowing what you're capable of doing as far as DIY home repair. And then there's probably certain things that you know that touching it is going to be a costly and could be a very detrimental thing if you try to do it on your own. Same sort of thing when it comes to figuring out how to fund the next 20, 30 years of your life in retirement. That is where the team at America's Retirement Headquarters can come into play to help you out with that, offer you their insight, their advice, and educate you, help you make that informed decision. All it takes to get started, phone call 419-794-3030, or the website. You can go to arhq.com, find out more, and set up a time to speak with them there. Now, if you invest in the stock market, one way to help manage risk, it's called diversification of a portfolio. The simplest explanation of that, not putting all your eggs in one basket. The Wall Street Journal said that a well-diversified portfolio can lower risk and volatility and offer more consistent returns. So some pros, a lot of upside, and we all know the adage of not putting your eggs in one basket. Are there any cons of diversifying a portfolio? And with those in mind, is it still worth it? And how often should you actually diversify?
I think there's definitely pros and cons of diversifying your portfolio. It can be used in good terms, and it can be used to diminish your returns as well. I use the context, if you look at the world of investing, you have large, medium, small, international stocks and bonds. And then what happens is a lot of investment approaches are designed to put a little bit of money into each of those categories. Give you a perfect example. If you have like a target date retirement account, as you get closer to that target date or your retirement date, what happens is, they're going to allocate more money to the fixed income environment. They're going to reduce equity exposure. And if we look at the past couple of years, what happened is you had a lot of these people that were getting close to retirement time, and they were moving money into decade level low fixed income environment. And so, as we know, usually when interest rates go up, bond prices go down. And as interest rates skyrocketed, those people that were getting close to retirement time, thought they were diversifying, and they were getting put into a terrible asset class that had little to no opportunity with where interest rates were, and they really got clobbered over the last couple of years. I almost look at it in terms of like shooting a shotgun, right? It's like going out back and blasting off a shotgun, and hopefully you hit something. Now, I served in the United States Marine Corps, and when I was in the Marine Corps, you either hit your target or you missed. It's either bullseye or nothing. So in thinking of terms of diversification, yes, I think there are things that are important out there. But what I would recommend that folks do is to take a sniper shot approach at identifying what do they want to have inside of their portfolio. I also see a lot of people who own variable annuities as another example. And in a lot of these variable annuities, they will just traditionally put people into an asset allocation model. And again, the thought process is hopefully more goes up than down and you make money. That to me is not the proper use of diversification. When we look at diversification, what we do is we look at it based upon timeframes and what the intent is of the portfolio. And this process is known as the independent income system. And so within the independent income system, what we want to do is we want to have a bucket of money that's designed for reliable income. Well, there's certain investments that are designed to generate income that can be part of that part of the plan. Just the same as you want to have a part of the portfolio that's designed for long-term growth. And so when we're thinking about long-term growth, I can't think of over the long term any other, better category than having like equity type exposure or growth oriented investments. And so you kind of get these things messed up. Chaz, who's been on the radio multiple different times, the other thing that's very interesting that he talks about is diversification between investment location, meaning that, you want to have the right investments in the right account, dependent upon your Roth IRA or your 401k or your after-tax account. Your Roth IRA, the advantage of that account is you don't pay taxes on the growth and the profit. So if you wanted to have something that maybe had a little bit more growth potential, even that of diversification of asset location makes a ton of sense. So I think a lot of times companies and firms, they take the easy, lazy way out. And again, they just use a traditional asset allocation approach and say, hopefully more go up than down. And that to me is not using diversification in your best interest. To me, it comes down to what I was explaining. When you're looking at diversification, taking that sniper shot approach of identifying in your portfolio what is the end goal and the intent that you're trying to accomplish, the time frame on when you're going to want to use it, and that can help you figure out what should be the right diversification in your portfolio.
I would take it one step further and say that people who invested in bond mutual funds over the past several years really have had a difficult time because of what you said, Nolan. When interest rates increase, the underlying bonds that support them decrease. And I found myself having more and more discussions with clients about buying individual bonds, like buying a treasury bond, buying corporate bond, where you know exactly what your yield is and you know what your risk. If it's a government bond, the government is backing the full value of the bond. But what you have to understand with buying individual bonds is that you pretty much have to keep them until maturity. Mm-hmm. But by keeping them until maturity, your interest rate has been a lot more attractive, and you've really taken the guesswork out of how much this can fluctuate. So from a diversification standpoint, how you allocate your fixed income, it really does matter. So when you look at growth versus fixed income, what is your long-term perspective? When are you going to retire? What kind of targeted rate of return do you need to have the nest egg that you're hoping for at retirement time? And that's what we will help you do here at America's Retirement Headquarters.
Help you better understand, that diversification or lack thereof in your retirement plan. Show you things that may not necessarily be tied to the market. A lot of people think that diversification is, in fact, having multiple stocks in multiple places, multiple mutual funds. You find yourself laterally stacked. So finding other ways to truly be diversified comes with a better understanding. That is what the team at America's Retirement Headquarters can help you with. All you need to do to begin the process to start that conversation is reach out right now. You can go to arhq.com. You can click on the events tab, find out about the upcoming events they've got in the next couple of weeks and register to attend one of those. Or you can give a call, set up a time to speak with them right now. Skip the line, 419-794-3030. Now, should you weigh yourself every day? Some doctors think that's actually a bad idea because it can drive you nuts. The scale doesn't include critical factors like your blood pressure, your heartbeat, your body temperature, and the weight reading alone can make you anxious about a lack of progress and results. There has to be a parallel, I would imagine, when it comes to checking stock prices or your portfolio every day. Isn't that your job to help people stop doing that?
It really is. I think if you look at, the problem that we face today is, with 24-hour news media, it can be in your face quite a bit. I remember going over to my parents' house and I would walk in and typically the 24-hour news channel was on, and I would always be like, turn that off. But I would say, really the same would be true about looking at your portfolio every day. In 30 years of doing this, what I would say is that when people look at their investments on a daily basis, it leads them to make much more short-term changes to the portfolio. And usually those short-term changes don't oftentimes work out. And those can be, costly mistakes. Once you have a solid plan in place and you understand how that plan's going to work, having, quarterly or just like when you go to the dentist, every 6-month checkups on your portfolio is going to be probably the better way to help you stay focused on the long run, not the short term. I can tell you from personal experience of talking with people and, getting concerned conversation to the people that typically are looking at their investment accounts on more of a regular basis. On the flip end of the scale, I have some clients that we had our meeting with a couple weeks ago, and what they had told me is that they're going on another 4-week cruise. So we better figure out everything that they have to plan for now and get their investments good to go, because they're going to have limited access as they do another trip around the world on a cruise. And so what we want to do is get you to a point like that where you're not looking at your investments on a daily basis. Instead, what you're doing is you're focusing on the travel channel. You're focusing on spending time on the golf course with kids, on the boat, grandkids, going out and using that money that you saved and worked your entire lifetime to enjoy the fruits of your labor. Looking at your portfolio every day is only going to stress you out.
The team at America's Retirement Headquarters, they can help you with that. Just reach out, set up a time to speak with them. 419-794-3030. There's a new study from Global Atlantic that says 61% of retirees would rather preserve their money than grow it. The study went on to show that 65% want an income for life, 69% reported discussing loss prevention with their advisors. Guys, does the fear of losing money work against some people to the point that they can't grow their money enough to fund that long retirement?
Well, I would certainly agree with a lot of people thinking that way. When you talk about preserving, okay, is there ever a point in time when a 0% return is good? The answer is absolutely there is. So does that mean that you invest conservatively and say, I just don't want to experience losses? This is where doing a stress test of your portfolio is so important. We utilize Riskalyze here at America's Retirement Headquarters. And when we meet with a person, the way we stress test their portfolio is we plug all their investments into some software, and it will kind of give you a speed limit on how fast your money is running. So if you're at a 65 miles per hour, you're pretty much in S&P 500. You're tracking the major indexes. Should you be at that point in retirement time? Most likely not. You kind of want to manage that speed limit to get a little bit, to be a little more, consistent over an extended period of time. I would also say that the other thing that this software does is it talks about if the market has a great year, how much of the upside of the market will you capture versus how much will you lose on the downside if the market is off a little bit or off a lot. And it gives a range with a 95% competency level or confidence level. And when we show clients numbers that say, okay, on this portfolio, you can capture 15.5% of the upside, but on the downside, you're only going to capture 6% on the bottom. So people that were fully invested in 2008, they understand what it's like to see a 40% drop. Mm-hmm. They don't want to see that in retirement time. So therefore, having stress tests, letting us do that work to give you an opportunity to smooth out your ride in retirement, that's very important.
And I think, to me, it really comes down, again, knowing what you want to do and what you want to accomplish. And, retirement time, all roads lead to income. So when we're looking at that, we want to make sure that our retirees in this example, 65% want income for life, 69% reported discussing loss preventions with their advisor. Just as that, you talk about creating an investment policy statement, that's going to help somebody to really understand, what a portfolio might experience. And then, as you're traveling throughout this journey, you're meeting with your advisor, as long as you're in those ranges of return, then, you're in the guardrails, getting the things that you want to have accomplished. Taking that a step further, though, I think there can be a lot to be said about some preservation money and some growth money. And it really, again, it comes back to what we build out and what we do here at America's Retirement Headquarters. It's called the independent income system. And with the independent income system, what we're doing is we're looking at having enough income that's going to cover your minimum monthly income needs. I know we had recently had a lady that came into the office, and we took a look at her situation. And when we added up what her minimum monthly income needs were going to be, and what we were able to do is take a look at things like the Social Security, whether she had a pension, and or figure out what other investment vehicles we could utilize to provide income either for a set number of years or provide income for the rest of her lifetime to help fund what those minimum monthly income needs are. And so if you're the type of investor right now and you're taking money out of your stock market account, you're the type of investor that I think maybe really needs to take a look at the advantages of the independent income system, because if and when the stock market goes down, you end up in a situation where you're forced to sell off more and more of your shares to get the same paycheck. You actually negative compound your account. You accelerate the risk of outliving your money. Oftentimes, people want to make these shifts after something bad happens. When you look at it, there's really two ways that you can lose money in the stock market. First, if you own a company and it goes bankrupt, you pretty much lose your money in that stock. The other way is you buy an investment, it goes down in value, and you panic and you sell it. And so people will switch from growth when they think things look good and go to safety when the market's doing bad, kind of a losing strategy. And a lot of that comes down to, again, not understanding what the plan is and what the purpose is for each of your accounts. Your safe money is going to be the money that's going to be there designed to provide you your income that you need. Even when it comes down to the stock market part of the portfolio, I think it's very important that you understand the methodology and the philosophy that is being used to pick your investments. On an earlier segment, you had talked about knowing what you own, knowing what your disciplines are. And that's where it can get very challenging when you go on the internet and you read all of these different articles about all of these different, hot investment ideas. And what happens is you end up, short-term chasing what oftentimes can be losing opportunities. Our discipline and a good example of something that we typically like is we like companies that are cash rich, companies that are low debt, companies that have a high profit margin, companies that offer a competitive advantage and or are needed on a daily basis. And so when you own those companies and you know why you own those companies and you know the financial health of those companies, then you become the type of investor that instead of panicking, when everybody else is panicking, you're going to find opportunities and say, how do I take some of that, safe money and how do I get more of those growth assets when everybody's panicking and doing that? So yes, there is a lot to be said about that. But again, the solution to that is taking a look at the independent income system. And then one of the things that we can also do here at the office for you is take a look at stress testing your portfolio. So if you're wondering in your situation, do I have the right mix of safe versus risky? Is my portfolio optimized to try to achieve the highest outcome for the level of risk that we're willing to take? If you have more than $250,000 saved up for retirement time, we'd love to have a conversation with you, and we can give you the printout so you know exactly what the numbers are. We'd be happy. All you have to do is call the office and say you'd like that independent portfolio analysis, and we'll put that together for you.
I like to think that the messaging around retirement has changed a bit, where it's not just this one finite set of time, this one final set of time. There's different chunks of different phases in there. In the same way, you need to understand there are different phases of your money. You won't need money for X number of years or Y number of years, or this is for the more immediacy, things like that. So you can have different allocations as far as risk, as far as safety. You can preserve and grow at the same time. That is where the independent income system comes into play. And so to get a better understanding of how that's going to work for you, to see how it all works for you, reach out to the team right now, 419-794-3030. You can also go online and find out more about the independent income system at arhq.com. I believe it was Benjamin Franklin that said, "There's nothing certain but death and taxes." But a new report shows that many don't understand the basic facts when it comes to probate, which is a component in once you pass. More than half of Americans have no idea what probate costs. Less than half understand that inheritance is not automatic, and roughly 2% know how long it takes to actually settle an estate. When you guys help plan a client's estate, getting to, through, and beyond retirement, do you try to keep as much as you can out of probate?
Well, I went on the internet and I Googled, is probate bad? And Google said no. So there's your answer. I guess when you look at, probate and trying to keep things out of probate, probate is a process. And, the process is, to transfer assets from your name into who could be your beneficiary. When we look at probate, I think a lot of the challenges about probate is, number one, is it can be very time consuming. Probate can take several months to years really to complete, depending upon, how complex the estate is, whether there's disputes that arise, during that time, beneficiaries, can have some different disagreements, and that, can create delays in the process. Number two is it can be costly. So probate, the process can be expensive, including, court fees, attorney fees, executor fees, appraisal fees. These fees really can eat into the overall estate and reduce ultimately what goes on to those beneficiaries. Number three is that a public process. Probate is a public process, meaning the details of the deceased estate, including the assets, debts, identification of beneficiaries, become part of the public record. In fact, a fun exercise is to go on the internet and you can read a lot of the wills of the famous people because it's public information. In this day and age, I think many of us, including myself, want to have more privacy when it comes to settling the estates and keeping things more confidential. Number four is there's the potential for disputes, and I talked a little bit about that in the time delay process, but it really kind of opens the door to say, hey, that's not what I heard. That's not what I thought was going to happen. That's not what was told to me. Those legal battles further delay and also add additional cost. There can be some inflexibility with the probate process. It's governed by the state law, which can be rigid and may not allow much flexibility on how estates are administered. It sometimes can be a part of the process of freezing up those assets. So those assets are typically frozen until the final process is completed. And that can create financial difficulties for those beneficiaries who may need some immediate access to those funds. And really, it can be an emotional, stressful process. So I meet with a lot of great people, and, it's sometimes still shocking to me how many people have spent so much time, effort, and energy building up a big nest egg and net worth, but have done nothing on putting their estate plans in place and, ultimately going to leave their family with a huge probate problem. So all of those reasons are the reasons why you want to get this checked off the list. In fact, what we did is we put together the ultimate estate planning checklist. This ultimate estate planning checklist, what it does is it walks you through the decades of experience that we have. We're not attorneys, so we don't get paid to do legal documents or anything like that. But what we want to do is we want to help you make sure that you take the steps to plan out things properly. You have to understand what is probatable assets and what are not probatable assets. Good example of that is like 401ks and life insurance and investment accounts. If you name a beneficiary on that investment account or 401k or life insurance, it's going to go directly to who you name as a beneficiary. It's not going to go through the probate process. So it's much quicker, cleaner, private, and gets exactly to where you want to be. But dealing with clients and talking to them about the probate process, what would you say?
Well, we recently lost my mother-in-law, and I was her financial advisor. And I will say that she did a phenomenal job of making her wishes known. Secondly, making sure her beneficiaries were clearly identified. Number three, she worked closely with an attorney that was able to make sure that everything she wanted was going to be handled as expeditiously as possible. And not everyone does that. You know, I would say the most interesting scenario that I've seen is when I look at an account for a person and find out that his ex-wife is the beneficiary of that account and they've been divorced for years. So it's like, don't take for granted that everything is exactly the way you want it. It makes sense to have beneficiary reviews done. It makes sense to see how everything that you've laid out, how it coordinates with your estate plan. You know, things like health care and durable powers of attorney on your will. You know what? If I'm incapacitated and I can't make a decision, I want someone that knows my wishes to be able to make those decisions in my stead. And that's all very important. And with beneficiaries and with a proper titling of accounts, the probate process can be, it's never stress-free, but you can eliminate most of it by just having a solid plan. And here at America's Retirement Headquarters, we can help you craft that.
One way to help is with that ultimate estate planning checklist, which you can get by reaching out to the guys. ARHQ.com is the website. Yes, Nolan, as you pointed out, Google did say that, probate isn't bad, but it was a couple shows ago. Google also said that glue was an ideal topping on pizza. So perhaps, take that all with a grain of salt. Be prepared. Have a plan in place. That ultimate estate planning guide available to you. Just go to ARHQ.com or give a call, 419-794-3030. When checking into a hotel, you probably already know to avoid the minibar. That is because the prices of the drinks inside, well, quite frankly, they're astronomical. Here's another reason to steer clear. This young woman found out that just putting her personal water bottle in the fridge can result in an additional charge, so she called the front desk.
Hi, I see on the fridge it says that there's an additional $50 charge for adding items to the fridge.
If you put any personal items, they're gonna charge you $10 to the minibar only.
So, I can't put my water bottles inside the fridge?
No.
Oh, okay. And can we change the temperature of the room?
Yes, is it not working?
No, it's fine. We were just wondering if there was a charge. Thank you.
Now, the problem with fees in a 401k or retirement portfolio is much like in this situation. You don't know about them until it is too late. Can you help head this off with a little bit of preemptiveness with a simple look?
Absolutely can, Chris. The thing about fees is that if you're working with a fiduciary, which we are here at the Retirement Guys Formula and America's Retirement Headquarters, we have to fully disclose fees when you set up an account, and we have to disclose the fee and you sign off on it. So does that mean that the client is going to remember how much they're paying you? Not necessarily, but it's a discussion that can be held at any review meeting. A fiduciary has to disclose fees. If you bring account statements and 401k statements, we can determine what the fees are within that plan and what you're paying for it. And depending on the type of employer that you work for, there are some plans out there where everyone bears their proportionate share of fees. There are other plans where the company pays 100% of the fees. And then there's some where it's a little bit of both. So if you want to get a handle on that, that's a good reason why you should come and visit with us, because we can figure that all out. Because I will tell you, it is not easy to look at a brokerage statement or a 401k screen and say, gee, this is how much I'm paying for fees. But I think the one lasting point I want to make, and I've already made it once, is that by working with fiduciary, like we are all here at America's Retirement Headquarters, fees have to be disclosed, fees have to be signed off on, and you should have a pretty good handle of what you're going to pay if you come to work with us here. So in terms of the cost of fees, They can vary. They can vary quite widely. So the last thing I would say is, if you are paying fees and you don't feel like you're getting service for those fees, then that's a reason to have a second set of eyes look at your situation, and that's a good reason for you to come and visit with us here at America's Retirement Headquarters.
You know what I would say about this is that the good news is this is becoming more transparent today. And I'd say consumers that I meet with are more open about asking these questions up front, and I think that's fantastic. You know, so it's not uncommon for somebody to come in and ask the question about how the costs are in the portfolio. And I think it's a good idea. You know, if you're a listener and you're not sure what your fees and expenses are, it's your money. You should ask the company that you work with, and, you know, you should be able to be transparent in that. I do oftentimes find people that get shocked about the amount of fees and expenses that they're paying on their investment accounts. And when you see those high fees and investments, it's generally involving less or not as regulated type products out there. You know, a good example is a popular product in the marketplace today is like a non-traded REIT. You know, with non-traded real estate investment trust, there can be different fee structures that can be very confusing and difficult for an average investor to look at, which tends to make them even more complicated. On the flip end of the scale, a very popular product that a lot of firms use, but one that has quite a bit of cost associated with it, is a variable annuity. And so when you add in variable annuities, you have, you know, mortality expense ratios, you can have rider costs, you can have sub-account fees, and, you know, if you add up all of those expenses, those fees really add up. And a lot of times people just maybe are not aware of what those fees and expenses are. And there's nothing wrong with paying for fees as long as you're getting more value in return than what the cost is. And I think that's, Dave, what you were talking about as far as looking at a good understanding as far as the total cost in the portfolios, identifying those ones that, you know, kind of add value to what you're doing. If there's things that you have in the portfolio that you don't need, then maybe you could kind of get rid of them. I had a conversation with a client, you know, and 10 years ago, we put together an investment plan. And the thought process was, in 10 years when he retired, he was going to need some income out of one of his investment accounts. Well, because all of his other investment accounts have worked out really well over the years and he's been a good saver, he really doesn't need that income anymore. And so, you know, looking forward, his goals and objectives have changed. In fact, if we look at where rates are today compared to 10 years ago, not only could we eliminate the fee by spotting that fee, we're also able to upgrade the portfolio to take advantage of where, you know, the high fixed rates are today. And so in your situation, maybe you picked something out years ago, but things are a little bit different today. Even if you have like an annuity that's a couple of years old, it's worth getting together with a professional and making sure that you go through that. If you're an investor and you don't understand what your fees and expenses are, we really need to talk. We can provide you a printout that shows you what your fees and expenses are so you can make a better educated decision about what's right for your situation.
Having that fee analysis done is a great way to assess value, and perhaps there is even a better value out there if, you know, what you already have has been working with you for the past couple of years. A lot of great advances in technology, the financial realm, no different. So getting that better understanding all starts with getting that fee analysis done as part of the Retirement Team Action Plan, as part of sitting down and speaking with the guys at America's Retirement Headquarters. 419-794-3030 is how you begin. It's 419-794-3030. You can always find them on the website, which is arhq.com. I want to thank you for joining us today here on America's Retirement Headquarters, the home of the Retirement Guys formula and America's Medicare Associates. Hope you have a great week ahead of you. Hope you stay safe out there. Gentlemen, always appreciate you taking the time to spend with the listeners. And as we wrap up here, I want to leave you with the final word.
Just as always, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.